Perfect. All right. Well, you guys are here, hopefully, to find out more about personalizing commercial lending products at scale. We're going to talk through managing growth, figuring out when is the right time to grow, the risk that comes with growing a lending program, and as much as we can get into in 45 minutes. I am excited to learn more about this. I am not the expert. The two people I'm about to introduce are the experts. I am a consultant on content and community, so things very different than lending, although I can help you write about lending programs if you need. But we also have Justin Sherlock, who was the head of capital at Flexport and is also now a fellow consultant, and he does consult on commercial lending programs. So if you need help, feel free to contact him. And then Dami Payne, who is the head of product at Canopy, who I help out with on some content, hence why I am helping with this webinar. But I am very excited to dive in. Thank you for being here, you guys.
Amazing. Glad to be here.
Yeah, thanks so much for having us.
Fabulous. All right, so let's talk about growth first. Justin, you obviously have been through this firsthand from your time at Flexport. And as we say on this slide here, it says data shows that 52%, so over half of commercial lenders, want to launch new products in 2024. Why do they want to launch new products, and what does that mean for business financing in particular?
Yes, I think it's been a big theme of the last 4 or 5 years now, this embedded fintech terminology and the notion that companies should explore launching financial products for their businesses that they serve. I think there's really a couple of reasons why companies are interested in launching lending products. The main one, of course, first is that financial products have really strong margins. So, if it's a new way to monetize your existing data and the transactions that you have on your platform, it can be a really valuable strategy as long as you can identify how to serve those customers with financing. But really, I think there's also two important benefits to just the overall nature of a customer relationship. One is the type of relationship that you have once you start engaging with the finance stakeholders of a company. Really deepens your understanding of your customer's strategy. We're talking primarily in this webinar in the B2B context, but at Flexport we were selling logistics services to an operations manager. Once you start having a conversation about lending with the CFO of your customer, the nature in which that company interacts with Flexport has totally changed, and you're having a very different strategic conversation with the company. So it really it deepens partnership and wallet share and the ability to cross sell all your products once you start providing financial services. And then the last piece, which I'll keep coming back to throughout this whole program, is really data. So as a company that's trying to launch financial products, you want to make sure that you have some sort of unique data that gives you an edge in underwriting over traditional lenders or banks. That data is also used for targeting, and marketing, acquiring those new customers. So you have a distribution advantage, and then it's also used. Once you deploy the financial products, you start to get new kinds of data. You get financial data on your customers. Which you can then use in a whole variety of creative ways. So those are really the three things that I think are really strategic about expanding into loan products.
Is there anything, now that you've been through it, what do you wish you would have known before you went through it? What would be some helpful tips for those that, might be listening and are, where you were a couple of years ago?
Yeah. And Dami sort of has seen the evolution of the Flexport Capital business over the past three years. But really, I think we had a bit of a messy back end and a messy loan ledger because we kind of bootstrapped our program from the beginning in Salesforce. We didn't really have a lot of tech resources on this business when we started it. And so we were initially doing our loan ledger in Salesforce, and then we built kind of an in-house tool, and then we moved to Canopy. And so when I look at historical reporting of the business, we're looking at 3 different loan ledgers and we're aggregating loans across all of those. And when we finally got the Canopy, the Canopy team was really helpful in helping us kind of collate and do that time series analysis that the investors require in order for us to fund portfolios. But I think I wish we had gone with a tech partner from the onset. So we had a super clean ledger that we could evolve with and run robust reporting on for both monitoring and risk management, but also for fundraising with our debt funders. So that would definitely be my advice is, it's good to be scrappy when you're launching new products at an early stage, but I wish we had actually kind of made a better long-term position up front.
Dami, since you worked with Justin so much on their launch, talk to me a little bit about how they differentiate their products and why you think Canopy was such a good match for them in terms of doing this versus, like Justin said, building their own product beforehand.
Yeah, I think Justin kind of touched on a few areas there, right? Which is, at the start when you're thinking about launching kind of a new product, leisure is not necessarily the first thing that you go to start thinking about, but it quite quickly becomes a constraint on your growth, right? Particularly as you start to see, data flowing in from your customers, you start to see kind of edge cases, so borrowers behaving in ways that you hadn't initially expected. You start to see kind of changing needs and a need to kind of tailor and launch and remix the policies of your lending product. And all of those complexities essentially get capped by what your ledger can support. So I think one of the things that we've really focused on with our relationship is how can we continue to add to the flexibility that we have there, and how can we be really attentive to the needs of customers like Flexport when they are looking to kind of expand and change, so that they can essentially launch kind of new products and new ideas. I think actually one example, Justin, you could potentially talk about this a little bit more, is sort of how the Flexport team started to sort of explore the kind of deposit financing space. So I think that's a really kind of interesting example about kind of how they started to understand different needs in the market, and then they were able to kind of use a ledger that didn't have the constraints of sort of a homegrown system to really move fast there.
Yeah, great point. Picking up a partner to specialize on the ledger, which is effectively like your business, right? As your operational data, it's the data on all your loans. Are you collecting? How much interest are you charging? Having something off the shelf that does all of those interest calculations for you saves years of engineering resourcing. So it was a no-brainer for us to do that. And then to that point, Dami, like every time we wanted to make a change to the product, or we wanted to add a new flavor of our financing product, we were able to do that in the Canopy system versus our in-house system at our Salesforce, which were pretty brittle. So the example, just for the audience, so they understand kind of the terminology, basically like Flexport Capital was providing, or is still providing, lines of credit, working capital lines of credit for inventory and freight costs that brands incur by buying goods from overseas. And so it's an accounts payable financing line of credit. What we realized when we were talking to customers was that there was a significant amount of their invoices from their suppliers overseas that was actually due up front. Those are called manufacturers' deposits. And no banks finance those. And they're significant. They can be 30 to 50% of the value of products. And typically companies have to pay cash off their balance sheet, or they have to raise equity to start production of goods. And so this was something that we realized was going to be a really valuable product in pretty quick order, pretty short order, if we could launch it quickly. And so we came to Dami and the Canopy team and said, hey, we want to launch this new loan product specifically focused on financing manufacturing deposits. And we were able to get that launched, I think, in like less than a month or something like this. It was a pretty short timeline, right, Dami?
Yeah,
Yeah,
exactly.
and it was, yeah, I think in the first month we did like 200K of revenue on it. So it was you know, a pretty big success after that.
Yeah, and I think that speaks to, coming back to this kind of 52% of commercial lenders want to launch new products. I think what it kind of really speaks to, and kind of Justin kind of touched on it, is that like the traditional banks and kind of not, financial institutions aren't serving kind of huge swathes of the market, right? There are needs that businesses have, particularly around cash flow, that traditional banks just don't provide the solution for. And really, we have, particularly after the COVID pandemic, a real explosion in the number of businesses, smaller businesses in particular, who are looking to expand and grow them internationally. And they were hit with these costs that ultimately prevented them from growing and competing kind of globally. So just having that ability to A, get really close with customers, and B, be able to kind of spot those needs and launch kind of new products really quickly is something that not just Flexport's experiencing, but we're seeing holistically across our customer base is becoming a real big need. And I think kind of partnering with them to kind of deliver those new products has kind of been really eye-opening into the investments that we've made there, and the value that kind of delivers at the end to the borrowers.
Right, right. Yeah, we'll get on to this. We'll get into this on the next slide a little bit, but yeah, the topic of personalizing commercial lending products. The idea is how can you create a new loan product that addresses a financing need that no one else has addressed before, because you understand a vertical end market better than anyone else, because you're some sort of platform. Or if you're a commercial lender, watching this, how can you access alternative sources of data and then build credit products based on that allow you to have a different view of credit risk than just the standard kind of bank style underwriting, which we also did at Flexport, but we also paired it with the alternative data to find these niches and build these custom products to address new areas that banks weren't addressing.
Yeah, and I think that's a natural kind of segue. I guess we can move on to kind of the next slide, which is around like timing, because I think that's the key piece here of, okay, you can spot needs, you can kind of understand what those problems are, but how do you know that this is the right time? How do you know that you've got the right amount of data, or that you have an opportunity to kind of underwrite in a new vertical? I think that's a question, Justin, that I'd love you to kind of dive into.
Well, I'd also say, like, he mentioned that they did 200K in revenue in the first like couple months. If he'd done it at a different time, he might not have done that much in revenue in the first couple months. So you obviously did pretty good on the timing front. So yeah.
Yeah, for that new product launch. Yeah, I think it was helpful because we had existing business to plug it into. I think it's a good question, because there's definitely always this debate of do you launch. Well, now I think in the current environment that we're in, there's always a debate of do you start out, is your product strategy, is financing central to your product strategy from the onset, or is it something that you monetize and layer on after you have transaction volume, or you have some sort of view of your customers? Like, do you use financing as a way to attract customers to your platform, or is it a monetization of the platform? And I think that's a very important distinction, because it totally changes everything, how you target, underwrite, how you collect, and the types of products that you're able to launch. So to be super specific on this, like with Flexport, once we had a certain volume of inventory passing through our platform, we knew that it was time that we could, as a freight forwarder who controlled cargo, we could start to take risk on those movements. And we had tens of billions of inventory flowing per year through our software and through our logistics partners. And so we thought, okay, this is a great opportunity. When we went into geographies that didn't have that freight volume, we actually used the financing products to get the freight volume quickly. And so that was true in a little bit in Asia. That was true in Europe as well, where our business was smaller relative to the US. So we had more kind of what we called capital-led deals, where we were having new customer conversations that had never moved freight with Flexport before, but were interested in Flexport because of the trade financing. And when you're looking at those like financing-led customer engagements, the type of underwriting that you're able to do is different, because you don't have all of the platform data that gave you such certainty on risk taking in the beginning. So I would say it's you have a bit of an acquisition advantage when you lead with financing, but you also have you don't have as good of an underwriting advantage when you lead with financing. So there's a trade-off there. I think it's I would say one is not necessarily better than the other. It depends on your risk tolerance and how much capital you have available to you. You know, if you're a small startup with only several $1 million on the balance sheet, you're going to need to be very conservative with those financing-led deal situations. But if you're a larger firm that's hoping to monetize, then you can be more aggressive on the capital-led situations. So that does that answer the question, Dami? I think how do you know when is the right time to scale is maybe a little bit a slightly different question, which is like, when do you want to start growing the loan book aggressively? Happy to get into that as well.
Yeah, no, I think you kind of touched on something that's really interesting, and I've had similar conversations across the board, which is trying to understand like whether you're seeing lending as a way to drive additional revenue on a target segment that you already have a fairly good understanding about, or whether you're using it as a way to expand into new markets. And I think both kind of present different challenges, right, and also different policy constructs that you want to build out, right? If you're going into a segment that you have less understanding about, then you may want to be more fee heavy, you may want to have more controls, you may want to make sure that you're kind of like adjusting kind of limits over time, and maybe graduating borrowers onto maybe a beginner product, then onto a more sophisticated product as you sort of get more data. But I think like the interesting thing about both is that you're really considering kind of lending as a core part of your overall business model, not as sort of a separate piece that kind of sits on the side. So I think like, in terms of like looking at timing, like I think what you kind of called out there is that there's a real conversation that needs to happen at a strategic level to kind of say that, what's our overall strategy as a business? Like, what direction are we going in? And how can we leverage lending in order to kind of drive us in that direction? Whether it's like monetizing, whether it's like growing and scaling in new markets, having a real firm understanding of that is a great way to kind of understand, what's the right timing for us as a business. But I think more specifically, and I've kind of like more thoughts around this is, what were the signals that you actually saw in the market that actually allowed you to kind of say that strategically this is the right time?
Right.
Any like early signals that you saw? Are you're speaking to customers and seeing that demand, kind of testing it out?
Yeah. So I would definitely get into signals, and I have a couple, but I do want to just highlight that point that you brought up around strategic alignment with management is so critical. And that is absolutely necessary if you're going to launch a lending product, whether you're doing it on your own, with whether you're putting your own equity dollars at risk or you're working with a loan partner. If you think that you're going to just kind of pipe in some partner and it's going to be really low touch and you're just going to show a loan product in your company's UX to your customers, it's not going to be that effective. It really does need to be a very central piece of your company's overall strategy when you start talking about, and because you think about salespeople, if you're in a B2B setting, you're selling a commercial product to businesses, your salespeople need to be trained on financial products and selling financial products to financial stakeholders. That's not something that they've ever done before usually. So that it's a significant lift for the org to implement financial products. It can be extremely rewarding and profitable if you do it, but I think that's a great point, Dami.
Before we move on, one quick thing. If anyone has any questions, please drop them in the Q&A. If you drop a question in, there is a gift card waiting for you at the end. So keep that in mind.
Great. Get those gift cards. All right. So signals, signals that it's a good time to launch. So, I mean, every new product has to start with the customer and customer data and the customer's needs. So, whether it's your account management team or your customer service team or your sales team, bubbling up problems that your customers are having. Financing is a way to solve some of those issues. So things that we were hearing at Flexport were like, my cargo is delayed because my supplier hasn't received payment for the goods yet, or I received this large order from a retailer, but I can't serve it because I don't have the ability to pay the supplier yet for that inventory. I need to sell more products and then order the inventory to service the large retailer in a month or two from now. Or I'm taking on a large air shipment because I need this inventory here in time to sell for the holidays. I knew that I was going to need this inventory, but I couldn't ship it on a cheaper mode like ocean because I didn't have the capital 3 months ago, and I have it now. So I'm going to do a really short, really, I'm going to do an air shipment, which is really fast. So these are just the supply chain and like retail examples, but your teams hear these problems from customers all the time, and one way to solve any of those problems is like, oh, we should implement better communications, or we should build software to help suppliers and buyers coordinate. Like there's always kind of these, ways in which product managers will hear this feedback and then say, okay, let's build software to address it. A lot of these problems exist because of financing and working capital gaps in supply chains. And so we saw that, and we started saying, okay, actually the solution to this problem is actually a financing product. It's not a better software product. And so that was, I think, how every good financing product should start. It shouldn't start with somebody on your board saying, we need to monetize this platform with financial services, right? Like that's what you keep hearing a lot in board meetings. And it's this very top-down product pushing kind of approach. And you really need to think about the customer data that you have, the problems that your customers have, and how can you help solve those problems with financing. That's 100% the kind of the first thing that I would recommend. The second piece is really around really around kind of the funding and partnership side. So when you're standing this up, I think you do want to put together a business plan and talk to debt investors or strategic partners that have built loan products that you're going to resell, and kind of do a little bit of research on how would they think about implementing this, and what's their level of interest. And so when we started to do that work, we realized very quickly that debt investors were very excited about this, and we saw competitive products that were launching that were not exactly what we wanted to build, but they seemed to be addressing a similar segment. So we sort of saw some smoke, and we thought maybe there would be fire there. So those are a couple of the other market signals that we saw, and we thought that we could build something that would be more kind of purpose built for supply chains.
Dami, are there any other signals that Justin didn't mention that you've seen or heard from other customers of ours?
Yeah, I think those are the main ones, right? Like I think a number of customers have talked about regularly like servicing, sending out surveys to their customers and getting like patterns and feedback that will kind of like tie back to, if we had a little bit more money, this wouldn't be a problem for us, right? So I think, making sure that kind of like product teams, that kind of client-facing teams are able to kind of identify those patterns and sort of build that up into kind of a consistent piece there. I think the other piece that is around like, are you gathering a lot of data is helping you to really like understand. And Justin mentioned this at the start, right? Like giving you an underwriting advantage, right? Are you getting unique data about a particular customer segment that you feel is like a better indicator of that business's success than like historically other kind of businesses will have access to, right? And that could be like either accounting information, payment information, how they use your software. It could be their like regular kind of banking transactions. There are so many different signals that you could be taking on about those businesses that give you a better idea of their overall future cash flow position, how they'll scale and grow over time. Leveraging that across your platform, but also launching products that allow you to gather that data more effectively, are all kind of signals that kind of allow you to head down the path of lending. I think like another like interesting one, which is more on like the personalization side, is sort of like kind of loyalty, like customer loyalty over time. One of the kind of customers that we have kind of discussed using sort of an internal kind of loyalty system where like their kind of borrowers and customers are rewarded for kind of using their product and sort of scaling over time. And what they've decided to do is like rather than take those sort of like points that they build up from actions within their platform and using that to sort of drive sort of maybe cashback rewards, as you would see from like a ramp card, that they actually want to leverage that into sort of like personalized lending offers. So to kind of say like, look, we've seen like overall loyalty on our platform, and because of that, like we know that you are someone who has regularly kind of used us, you regularly scaled, you regularly grown. We're actually going to leverage that into discounts on lending products. So, typically, if you went out to market, you may see a 9% interest rate, or you may get like a 2% fee. But actually, because we've seen your behavior across our platform, we're actually going to lower that fee, right? So you're kind of saying that like you may even find offers for financing elsewhere, but because we've seen you as a loyal customer, we want to sort of offer you financing at a cheaper rate that you can get elsewhere to keep you on our platform to kind of increase the lifetime value of that customer. And in fact, they've actually recently been kind of discussing with us and working with us to kind of leverage those rewards to go even a step further to say, well, now that you've got a lending product on us, how about we use those rewards to offer you perks in that actual lending product? So, for example, the ability to skip a payment, the ability to waive interest, essentially like leveraging rewards and loyalty into kind of lending and ultimately into customers who kind of are sticky and kind of stay on your platform altogether.
Something that we haven't talked about yet, and I don't know that there could be a lending or financial webinar without talking about it, would be risk. As companies and programs decide to grow, there's obviously more risk and challenges involved in that. Dami, I'll stick with you on this for the start. What are some of the challenges that you see companies face as they decide to scale, and how do you guys help them manage the risk involved in that?
Yeah, there's so many different areas, and I'll just pick a few to kind of and give some examples as we kind of go through. So I think one of the ones that we see very commonly is sort of like financial reporting and reporting as a whole. When you start out with any sort of lending product, reporting isn't often the thing that comes straight to your mind. You're like, okay, let's just think about how we're actually going to get this out in the hands of our customers, how we're actually going to account for it. But you quite quickly run into challenges, particularly on the financial compliance side, to find that you actually are lacking a lot of the core data and reconciliation you need to accurately close your books and accurately report to your investors, be that private or public, as to the state of your lending program. So quite often we've seen kind of customers on their own kind of custom portfolios, built on their own custom software, and they've run into massive challenges in sort of lacking a lot of core historical data that they need in order to report on their overall portfolio. And they don't have the capability to go back historically and say, like, how do I actually like rebuild that data? So they struggle to go out to market to kind of raise more debt or to sort of expand that program in the eyes of their board, because they don't have that kind of core information. And what something like a Canopy allows you to do is we actually have the ability to go back and resimulate all of the accounts that we have on our platform. We can produce historical data, but also we've got a real kind of like granular access to a lot of the data that sits across all of those different lending products to kind of allow you to report more effectively. I think the other area really comes down to kind of like technical complexity around edge cases. When you launch your lending program, again, you're thinking about it from the happy path, right? The customer comes in, they're going to repay on time, they're probably not going to miss any of their payments. We're never going to have to kind of change this loan. It's just going to always kind of run through. We've got like a lending product that's going to kind of, for the most part, follow the regular schedule. But what you find when you launch is that one, you become a target of people trying to do fraud or money laundering. So you get lots of weird behavior, unexpected behavior. Two, you find out that oftentimes borrowers can't pay. And that means that you've got to either kind of restructure or refinance, or you've got to offer payment plans to kind of keep those borrowers on tap. And you also find that all of those edge cases kind of lead to gaps in your calculations that you may not have covered in your custom homegrown system. And you get into issues with rounding, you get calculations being inaccurate. As you start to scale, a problem that only affects 1% of your customers starts to be a meaningful number of customers, and they start to sort of talk publicly about your product, complain, dispute transactions, and your operational burden starts to rise. So those are just two examples, but there are plenty more of other issues that when you're starting out don't kind of seem as major challenges, but as you start to scale, kind of really start to slow down your ability to kind of grow and scale your program.
Right. Yeah, I think that makes sense. There's really there's the three buckets, which is the initial underwriting, or maybe even four buckets. Initial underwriting, credit monitoring, so like monitoring the exposures as they're see if they're performing, are people making payments on time, how's the credit profile of the borrower evolving over time, and then there's the servicing element, which is operational risk, to Dami's points. And then if there is a situation where payments aren't being made, what's your process to work that out? And how does that impact your loan ledger and your reporting to your capital markets? And then this gets into the fourth piece of risk, which is really that compliance piece. Are you doing are you getting the accurate reporting out to your regulators and to your capital markets partners? And so they all kind of flow together, but most people when they're launching financial products really think about the initial underwriting, and then they sort of don't spend as much time on the credit monitoring, the servicing and collections process, which directly affects the ledger, and then the compliance and regulatory and capital markets reporting. And all those are actually all like pretty equally important things. Because you can do a bad job of initial underwriting and still be pretty successful as a lender if you do the monitoring, servicing, collections, and compliance piece as well. And in fact, it's actually good to kind of experiment every once in a while and take a little and push the boundaries of risk a little bit to make sure that you're not growing slower than you could be because you're being really conservative on initial underwriting. So that you can only do that if you have the servicing, collections, and compliance pieces locked, and the monitoring pieces locked in. So the other thing I always advise the companies that I work with to focus on is when you're scaling your loan products, it's really, you need to really focus on targeting companies that that you want to approve for loans. And you need to have we talked about differentiated view of risk before, using your platform data or customer data or alternative sources of data. You want to develop an alternative view where you can lean in and provide financing where no one else can. And then you want to go and target those types of companies, ideally using the data that you're underwriting with. And that way, when you have a sales conversation, you're going to have a really good customer experience because the company's going to come in and get approved quickly and receive a loan quickly. So lining up that go-to-market and underwriting is actually really important. And a lot of businesses sort of think that there's like should be this healthy animosity between the business development function or the investor function and the credit function. And I actually think those functions need to have much more overlap than people generally think. And it should stem from your data strategy, your underwriting approach. So yeah, those are my 2 cents.
I think a really interesting question, Justin, is like, what's the biggest learning that you had, right? Like going back to the kind of the original launch, what was the one thing that if you felt that, you know, you had changed would have actually kind of accelerated your success even more?
Yeah, I was asked this. I was asked this 2 days ago, actually, by an investor. They were like, "Why didn't you grow it faster?" And I appreciate the question. I mean, I definitely have thought about this. I would get this question at Flexport all the time. You know, you're doing so well. How can you triple this or 5x this next year? And I think uh, the biggest hurdle that we faced was really accurate data and reporting, and the fact that we changed our ledger so many times in 4 years, and we weren't able to build something from the onset that we knew would be scalable immediately, meant that we had to spend a lot of time doing rework to get the right reporting to do the targeting, underwriting, and capital markets work. So we, you know, ended up moving a little bit slower in all areas of the business because our foundation, our tech foundation, wasn't terrific from the get-go. So that was definitely my answer to that investor the other day. And I think, you know, there's other things that maybe the team is actually making big strides on now, after I've left, with unifying kind of how the go-to-market works. So do you have separate teams that sell, do you have specialized sellers selling specialized products, or do you have, you know, kind of one sales team that controls the go-to-market motion? That's evolved and changed multiple times over the last several years at Flexport, but is definitely an important consideration. How do you line up the go-to-market for specialized sellers of financial products versus the overall, you know, platform? So yeah, those are really my two topics.
Justin, there's a
Yeah.
question from the audience for you that I want to make sure we get to, and it's when you guys at Flexport launched products in the past, you know, interest rates were a lot different than where they are today. How do you take that into account when thinking about scaling programs now that rates are, you know, substantially higher than they were in 2020, 2021?
Mm-hmm. Yeah, there's a couple. I mean, interest rates affect several pieces. So the first one that's kind of most obvious when you have a product that's already launched is your funding cost fixed or floating? And so and does that imply that you need to make a change to the products that you're providing to your borrowers? So for instance, Flexport's products were actually fixed rate products before rates started going up, and we realized that our, you know, funding costs from KKR, our investor, were floating. So we had a spread, you know, base rate of SOFR plus a spread, and that was the price at which we were borrowing to fund the loan book. But our you know, facilities were all priced in kind of the low teens, and so as interest rates went up, our margins were decreasing. So we said we actually need to convert our facilities to floating rate products, and we then had to go have those conversations with all of our customers who understood the concept. I think, you know, they were very in the B2B setting, they're generally used to floating rate debt products. So it wasn't that hard of a challenge. But for a lot of fintechs, a lot of fintechs are providing fixed rate products, and so you have to be thoughtful on how you market that and how you convert those facilities. I think when you're launching a new product, the interest rates that you're selling at determine the quality of borrowers that you're able to have, and so you need to find a kind of middle ground where you're able to make enough margin by having high enough rates, but they're not so high that the only people you're doing business with are really poor credits. And this is just a very difficult trade-off that you have to walk in the lending business, where, you know, yeah, I mean, as a lender, you would love to be in the 20 to 30% APR range, but you know, those types of borrowers are obviously going to be much riskier than people that are borrowing in the 10 to 20% range. And so where do you sit in that, in the range of products, from credit cards to a small business loan or bank loan. Where are you going to play? What's your interest rate range going to be? And I think with interest rates going up, it's allowed fintechs to kind of move their pricing up a little bit. And I think borrowers now versus 2 years ago are much more comfortable entertaining double-digit APRs in the commercial setting than, because they're realizing actually that a lot of their bank products are high single-digit APRs, and that doesn't even include all the wraparound fees that banks charge. So you're starting to see businesses start to understand that borrowing costs are much higher now. And in the middle market, you can charge mid-teens rates on junior debt products, and that there's kind of so thinking about your pricing strategy in context of rising rates is a really important topic. It's a good question.
Dami, I think there's one here for you. Let me find it. Yeah, so something else that has changed since 2020 is like the credit cycle has evolved a lot. And as someone that's covered fintech for a long time and lending for a long time, people are always talking about, oh, like these lenders and stuff have only been around in like good credit times. And I would argue like we've gone through like different dips and stuff now. So how are you seeing customers leverage platforms like Canopy and elsewhere where you can dive a little bit deeper into the data to make sure you're not getting, caught with a bunch of delinquencies all at once that your models weren't anticipating?
Yeah, so I guess the COVID pandemic was obviously a big shock, impacted a lot of businesses, and it did force like a lot of lenders to really have to think about how they manage the delinquency. And as we look towards the macro environment, with interest rates staying high, delinquency is definitely going to be and how you manage it is definitely going to be a theme that commercial lenders who want to be successful have to have a really good handle on managing. I think particularly with business lending, and this kind of comes to personalization, it is about like leveraging those relationships and understanding what the role of lending is across your entire business. I think on the first part, kind of leveraging those relationships is that if you do have kind of larger businesses in your portfolio, who have been on your platform for a long time, have shown a really good lending record across the good times, I think that particularly with the customers that we have, they have they've been successful. They've really leaned on that to kind of say that look, we've seen your track record. We understand that you're struggling right now. What can we do to flexibly help you to extend the loan duration, to understand how we can adjust payments and maybe delay payments for a while, in order to kind of help you through that period. And almost all of the lenders who did that during the COVID period, and took the lean of like, this is not the time for us to kind of maximize our revenue, that we really should be trying to think about how do we maximize business success, are now reaping the rewards from that, because those businesses that have lived through the pandemic are now kind of strong drivers of their portfolio in terms of growth. And then I think on the second side around kind of really how do you kind of like understand that risk up front is taking a kind of a proactive approach to really understanding the impact of missed payments across your portfolio. And that's on the analytics and reporting side. How do you identify those risky customers? How do you look at the cohorts over time and start to understand, how are they performed? If we look at similar cohorts with similar profiles, similar credit risks, or any other kind of things that you're using to analyze risk for those customers, do we see similar issues kind of arising with those cohorts? And how do we get ahead of that, right? How do we start, again, proactively starting those conversations? How do we start proactively adjusting those policies for those borrowers before they start to experience change? And when we've seen that, when we've seen that our customers have leveraged kind of like the powerful notification system that we have to kind of reach out to those borrowers ahead of time, we've seen those customers see a dramatic decline in the delinquency rate compared to kind of the similar cohorts in the past. So really those kind of proactive kind of relationship building steps, particularly as those borrowers start to experience challenges, is really what has netted kind of like successful lending programs, because those businesses again have become a huge part of the growth of the portfolio.
Yeah, I love that, Dami. I think that goes to kind of what I was mentioning earlier around the areas of risk, in additional underwriting, monitoring, servicing, collections, and compliance. And I think like in the current environment where it seems like there's less stability for businesses, the way that you shift risk into across those four buckets is super important. So what we have been doing at Flexport is actually, a lot of business metrics were deteriorating, especially in the retail space and the consumer space and the supply chains were really deteriorating over the last 2 years. We couldn't just shut off borrowing. That would destroy our business and our borrowers' businesses. But what we did was actually get a little bit more aggressive on the initial underwriting, and then really tighten up on monitoring and collections. And so anytime there was a single past due or there was, a new monthly financial report that came in that showed a significant change in credit health versus prior month or prior quarter, that's where we started to really draw a strong lines on from a credit risk perspective. So we were actually having to, in order to continue growing, we actually were having to be a little bit more lenient in the initial underwriting, but then tightening up a ton in credit monitoring and in collection. So yeah, that was just one example of how we had been navigating it. But there's I think also that perspective of being long term, if you can afford to be, if you have the capital and the capital markets partners to be long term, it's so critical, because those companies that you help work through a difficult situation with will remember that forever. And I personally have built really close relationships with business owners because we were very partnership oriented, and we didn't, go straight to the legal option, which is never really a good outcome for anybody. So really believe in that point on being a long-term thinker in these relationships.
Yeah, absolutely.
Well, on that note, if you guys attending have any questions, there's some contact info below for both Canopy as well as all of us speaking here today. Thank you for the 2 people that asked questions, as well as the other participants. You will all end up getting an email with a Starbucks gift card, so watch out for that. As well as we'll send you the recording, and we're gonna put up a blog post summarizing what we talked about today as well, in case you have any questions that you want to come back to or anything. But Justin, Dami, thank you. I appreciate it. And happy holidays, everyone.
Yeah, thanks so much, Julie. Thanks,
Happy
Dami.
holidays.